Hello, everyone, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the Deferred Sales Trust, is a great way to exit highly appreciated assets tax deferred, so you create, preserve, and grow your wealth. I'm your co-host, Pearson York, filling in for Brett Swarts. In each episode, I'm joined by some of the best wealth, business, real estate, and leadership individuals in the world to share ideas, deal stories, and inspirations. So together we can make complex tax deferral strategies simple and passive income plans achievable. As always, we're streaming on expertcresecrets.com, the Capital Gains Tax Solutions YouTube channel, the Kingdom Luxury Realty Facebook channel, and a new one, the Phoenix RE Capital channel. And so please rate, review, subscribe, and do all of that fun stuff for the YouTube and Facebook and all those algorithms out there. And for our next guest, I'm really excited about. We're going to dive deep into cost segregation studies, how it can benefit you, when to use it, when not to use it. And we have an expert that is just niche down in the cost seg world. So please welcome Eric Oliver. Eric, how you doing, my friend?
I'm doing good. Thanks, Pierce, for having me. I appreciate it.
Yeah, absolutely. Well, you're going to add a ton of value today for our listeners because cost seg fits in really, really well with what we do and using them in tandem. But before we get into all that, tell us your story. How did you get to where you are?
Yeah. So, my background is actually in accounting. I've got a degree in accounting, and through prior careers, I ended up in some sales positions, moved to the East Coast for a number of years and was looking to move back West. Came across this company, always been interested in real estate. So I've been with Cost Segregation Authority for just over 6 years now, working with real estate investors, CPAs across the country on educating them on the benefits of cost segregation, how to utilize cost segregation, and how to maximize the tax savings when utilizing cost segregation.
Awesome. Okay. And so I believe everyone's been given a special set of spiritual gifts or strengths or superpowers, whatever you want to call them, right? What are one or two that have led you to be successful today?
Yeah, that's a good question. So I think I had to learn mine the hard way. I think one is just being able to identify my own strengths. Like I said, came across this the hard way. I tend to have to learn things the hard way. But knowing what my strengths are and then being able to outsource the strengths that I don't have and really utilizing experts around me is one of the things that I think I thrive at this point in my career. Not something that always came easy. I always wanted to do everything myself, kind of control everything myself, because I felt like if I was in control, I knew what was going on. But quickly, as I got into the business world, realized that, you can't be an expert at everything. So surrounding yourself with folks who are experts in their field is a great way to get things done. So probably go with that.
So you learned the art of delegation.
Yes, the hard way.
I
did it all myself at first and then realized it wasn't working.
But now you're delegating everything.
Yes.
Fantastic. Yeah. Delegation is a huge part of leadership, right? Because you can't do everything. And if you don't give away control, you can't grow. You become the captain of your own organization. There's a lot of bad things if you don't delegate and surround yourself with a team that's, finding the right people, like a solid team to hold strength and so on and so forth. But anyways, so that makes a lot of sense. So, okay, let's dive into this. Cost segregation. Let's just break it down really simply for the audience, and then we'll dive into when it's useful and some of the values that it can add for you guys.
Yeah. So cost segregation really is just accelerated depreciation. So a number of us get into real estate for some of the tax advantages, or tax advantages are a great benefit of getting into real estate, I should say. So when you buy an asset, let's say you buy a commercial building that's typically depreciated over 39 years for a commercial building or 27 and a half for residential.
Yep.
So just to make the math easy, let's say you buy a $390,000 office, you're going to get a $10,000 write-off every year for the next 39 years. Cost segregation comes in and says, okay, well, when you bought that office building, you didn't just buy the land and the walls. You also bought everything within that building and the parking lot outside the building. Mm-hmm. The IRS says that the personal property within the building, things like carpet, countertops, cabinets, portions of the lighting, portions of the plumbing, those should be depreciated over a much faster period than 39 years. So as you know, carpet doesn't last 39 years. Carpet's actually a 5-year asset. So we should be depreciating it over 5 years. The problem is when you buy that asset, you don't know the value of the carpet in that building. You just bought the whole thing for $390 and gave your closing statement to your CPA and started depreciating away. But if you have a cost segregation study done, we'll come in, do an engineering study on the building and identify those short-term assets, which allows you to front load those and take those deductions at a much faster rate. And there's a number of reasons why you'd want to do that, Pierce.
Yeah, absolutely. So I hope that makes sense. What we do is we just make sure that all the stuff that is not going to last 39 years gets appreciated sooner.
Right.
And you get the benefit of that. So who's a cost seg just like a home run for?
Anybody who owns real estate and is paying taxes is really cost segregation. It's not a matter of if, it's just a matter of when. So if we knew everybody's tax situation, if I knew what your tax bracket was going to be, Pierce, in every year going forward for the next 5 years, if I knew what your income was going to be, I could dial down and say, this is the absolute moment to maximize your tax savings. This is when you should do cost seg. We don't always know that information.
Of course.
So really, if you have a tax liability and you own real estate, it's definitely worth looking into. Sure. And then it's a matter of kind of keeping it in your pocket to make sure that you utilize those deductions when you can maximize the tax savings. So hopefully that answers your question.
Yeah, it does. So let me give you a case study. So sure. And let's just walk through an example.
Okay.
So let's say a property owner has owned a building for 20 years.
Okay.
Right. And they've just been straight line depreciating this thing and they got 19 years left on their, would you do a cost seg on that building?
Yes. And that's kind of a hard idea for some people to understand. Even when we educate CPAs, they're like, wait, why are you doing a cost seg study right before you sell the asset? Don't you just have to pay all this back in the form of recapture? And the idea is that we're going to go and identify these short-term assets. And by doing so, when you identify them, let me ask you a question. I'll kind of back into this example, but we're going to identify 5, 7, and 15-year assets within that building. Well, if you've owned it for 20 years, what are your 5-year assets worth? They're worth zero. They have zero book value, right? Same thing with your 7, same thing with your 15. So the idea is that when you sell that asset, you shouldn't be selling your carpet for more than you bought it for 20 years earlier. And if you don't do cost segregation, that's what you're unintentionally doing. You're saying, I bought this 20 years ago for $1 million. I'm now selling it for $5 million. When you go to settle up with the IRS, you're telling them that everything was 5x value in that property, but that's not the case. Your carpet's 20 years old. It's not worth more than what it was when you bought it. Carpet goes down in value. But if you don't have that carpet broken out, you can't allocate your sales price to the right buckets per se. And so you end up overinflating the amount of capital gains you have to pay.
Okay, let's dive into that a little bit more because that's super interesting, right? So basically what it sounds like you're saying is that if you do a cost seg before you sell it, you're able to say, hey, look, no, I'm not actually paying this much in gains because I've actually already depreciated these things, but I still have, and they're not worth that anymore, right? So they're not what is actually being sold.
Right.
It's this over here, which is being sold, but you're not
and by
capturing
putting
the
it
value.
over there. Yeah, no, you're right. By putting it over there, you're taking your deduction at your ordinary income rate and picking it back up as a capital gains rate and saving the spread. And you're not even picking all of it back up because your 5-year assets are fully depreciated. So you're not even picking all those up. You're picking up a portion of those.
Interesting. Okay. So what would you say to somebody who's going to 1031 then?
So 1031 exchange with a cost segregation it's great to use both those tools because then there's no recapture, there's no capital gains upon sale. You're just deferring those into future years. So we work with a lot of investors who buy a property, cost segregate, then 1031 exchange into a larger property, do a cost segregation on that new increased basis, sell it, cost seg, 1031 exchange. And then when unfortunately we all have to pass away at some time, we hand that down to our estate. They pay no taxes. They get a step up in basis and no one has to pay tax on the asset. So if for the right person, if they're looking to defer those capital gains, 1031 exchanges are a perfect tool coupled with cost segregation because cost segregation gives you your deductions now, 1031 on the back end so you don't have to pay any of that recapture or capital gains and just keep kicking the can down the road.
So what has been your biggest frustration with your capital gains in the 1031?
That's a good question. Eventually they're going to come due. I mean, I guess that's At some point, they're going to come due unless you 1031 exchange, 1031 exchange, 1031 exchange, and then die. Then you get that step up in basis. But for a lot of people who are looking to pull money out to reinvest in other types of assets, or we've had a lot of clients who anticipate 1031 exchanging, can't get into the property in time. They end up getting stuck with this large capital gain. And that's usually when they reach out to us and say, hey, I've got these other buildings. Can you cost seg these other buildings to offset this capital gain?
Yeah, so that's another interesting tool that you can use with a cost seg, right? You can help to use it to offset some of those gains if you've taken constructive receipt because your 1031 fails or whatever. So you probably do have a lot of clients that are able to do that.
Yeah, we do. And so we're able to come in and kind of help them at the end. The nice thing is when you have that capital gain, even though we're doing the cost seg study, and I don't want to get too far into the weeds, but oftentimes the cost seg study will unlock the deduction up to the value of the capital gains. And for those who aren't real estate professionals, it oftentimes hits their W-2 income first before it offsets the capital gain. So you end up paying your capital gain, but you're offsetting your W-2 income by the amount of the capital gain when you do the cost seg study.
Gotcha. So it's just one tax savings here, not there. Right. So if you have $100,000 tax liability because you have a W-2 job and you have a capital gain, well, you do a cost seg, you might not have any of W-2 ordinary income tax, but you're still going to have the capital gains tax.
Right, which is fine. I'd rather pay my capital gains at 20% than pay my W-2 at 35% or whatever bracket I may fall in.
So actually it hits your W-2 first before the capital gain.
Yes, typically.
So you're saving that, obviously your brackets, right, and your states and all that kind of stuff. But you're saving a significantly more amount, significantly higher amount in taxes because you're offsetting ordinary income, not just
the capital gain. Right. Yep. So the other thing we can do, another strategy we employ oftentimes is if you do have a capital gain, but you own other real estate, if you can use cost segregation to get your income down to zero or close to it, you now find yourself in a 0% capital gains bracket, and you don't pay capital gains on some of those transactions. So you can use cost segregation to get you out of that 20% capital gains bracket down into the 15. And we've even had a couple of cases we were able to get them down to zero, and they paid hardly any capital gains on that, the sell of that asset.
So this sounds like super awesome, right? Where are the pitfalls? What do people need to, when is it not a home run?
So it's not a home run if there's a passive loss issue. So if you don't have significant income to offset, it doesn't make sense to pay us to accelerate these deductions.
Okay.
So to give you an example, you buy $1 million asset, we create a $300,000 deduction. If you're already operating at a loss, or maybe you're operating and you're showing on paper that you only made $30,000 of income, it's going to take you 10 years to utilize a $300,000 loss. So don't pay us to accelerate it when all you're going to do is decelerate it on the back end, and it's going to take you 10 years to use those deductions. So really the only time you wouldn't use cost segregation is if you don't have a tax liability or if there's a passive loss issue. So maybe all of my income is, maybe I'm a high W-2 earner, maybe I'm a doctor, I'm a surgeon,
right,
and I own some real estate. My real estate doesn't make a lot of money right now. I wouldn't do a cost seg study on my real estate because it's not going to offset my high W-2 surgeon income. It'll only offset my passive investment, my real estate investment income. And that's why you see a lot of professionals have their spouse qualify as that real estate professional, 750 hours, half of your working time doing real estate, because the rules will change if you qualify as a real estate professional, in terms as you can now take the deductions we create in the cost seg study and use those to offset not only your investment property income, but also your W-2, in my case, it would be a doctor surgeon income, right? And so we see a lot of professionals, lawyers, doctors, dentists, where maybe their spouse is able to stay home because they have high W-2 on one end. That spouse becomes a real estate professional, and they use the deductions to offset the surgeon's income.
So that is the one caveat that you have to have within the cost seg world to offset your W-2 income is you have to be a real estate professional.
You have to be a real estate professional, or there is a opportunity with short-term rentals. We're seeing a lot of that now. If any of your investors invest in short-term rentals, where they get treated as kind of like a hotel versus a rental property, the average stay is less than 7 days, et cetera, then oftentimes you can set those up in a manner that the deductions from that Airbnb can be used to offset active W-2 income. So there's kind of a loophole there that there's an opportunity to take advantage of.
That's super interesting. Let's dive into that a little bit. How does that work?
Yeah. So basically what you're doing there's you have to pass a couple tests. So the IRS looks at it like instead of a rental property where you've got somebody staying in there for over 30 days, if you set up your Airbnb on your Schedule C, you're actually treating it like a hotel. And if you materially participate, there's 7 tests that you can pass, or you have to pass one of the 7 tests to show material participation. Things like spending more time than anybody else at the property, spending 100 hours at the property. If you can pass those tests or one of those tests, then you're basically saying, I am the manager of this hotel, even though it's just a one room hotel, it's just an Airbnb. You're setting it up as a hotel. You're treating it as a 39-year commercial property. And because you actively participate in that hotel business, that income is now active, and that deduction that you create is also active, which means it hits your active income, or your spouse's active W-2 income.
So let me ask you this. Let's say you have a triplex on the beach, right? And you Airbnb out 2 of the units and you live in one of the units and you bought it as a primary residence. How would you finagle that?
There's a lot in there. There's the so primary residence, just so you know, anytime you live in the building before you turn it into a rental, it does exclude you from something called bonus depreciation, which we really haven't touched on. But bonus depreciation basically takes our cost segregation study and puts it on steroids.
Okay.
Meaning that when we identify, let's say, 5-year assets that normally get depreciated over 5 years, under the current tax law, those 5-year assets, you get to take 100% of that in the first year.
Okay.
And so one thing we always advise investors is don't ever, even if you're only going to live in it for 6 months, try not to live in the property that you're going to rent out if you want to maximize the deductions, because I think the IRS is on to us knowing that we're always going to look for ways to get around the tax law or to maximize the tax law to our favor.
Of course.
And so any investor would say, well, hell, I'm going to rent out my home for 6 months, take my bonus depreciation, then move back in. And so the IRS says anytime it's a primary residence first, you don't get to take advantage of bonus. But in that instance, you actually, the 2 units, the 1 unit was your primary, but the other 2 were rentals from the start. So that other 2 would be eligible for bonus. Cool. And if you Airbnb'd them, it would be easy to show that you materially participate because you live on the property, almost treating it like a bed and breakfast type place where you're actually live at the property. Set it up on the Schedule C, materially participate, as long as the average stay by a unique guest. So you take your total number of days that it was rented out, divided by how many different reservations you had. As long as that's less than 7, then you're able to take those deductions against your ordinary income, or you may be able to take those deductions against your ordinary income.
Interesting. Hopefully you guys are catching that, because
it's a hot topic right now.
That's a hot thing.
A lot of, because that was one of the downsides of cost segregation is for a lot of investors who aren't real estate professionals, they don't need a big, huge loss on their real estate because they don't show a lot of real estate income yet. And their income may be coming in for a W-2 job as they're transitioning over to becoming a full-time investor. And so with this little workaround, you're able to, like I said, use the deductions from your short-term rentals to offset W-2 income. It's a great tool.
Interesting. Okay. We touched a little bit about bonus depreciation. How, and obviously they're titrating down the amount that you can take over the next, couple of years or whatever, right? They're planned to 0 or whatever the thing is, right? So how are you guys faring with that right now? Are you handling it?
That's a good question. So just to kind of go back to bonus depreciation was enacted as part of the Tax Cuts and Jobs Act of 2017, 2018.
Yep.
So that's when Trump was in office. Obviously, Trump's a real estate investor. He came up with his tax overhaul, very favorable to real estate investors. And the reason it's so favorable is because, again, any asset that has a 20-year life or less, which, again, when we do a cost seg study, we're identifying 5, 7, and 15-year. So all of those are under the 20-year category. They're all eligible for 100% bonus currently. That does start to phase out next year. It drops to 80%, and then the following year, 60%, until it's down to 0 in 2028. Now that's the current tax law. However, I think there's a lot of miscommunication, or not misinformation out there, in that it's all based on when you put your property into service. So, Pierce, if you put your property into service today, but you don't do a cost seg till 2025, you're still eligible for that 100% bonus because your in-service date was in 2022. So any properties you put into service next year in 2023 will only be eligible for the 80. But even at 80%, that's still massive deductions.
Totally.
I mean, hell, we were doing cost seg when there was zero bonus. Cost seg still makes sense to move an asset from depreciating it over 39 years to only 5 years. It's just that now with bonus, it just, like I said, puts this on steroids and creates these massive deductions that people can take advantage of.
So let me ask you this. Once you've depreciated it, right, and you get, you do a cost seg, right, and you take your bonus depreciation, right, and you've accelerated that depreciation, where do you go from there, right? Because one of the benefits is that you get that depreciation, and I know you're only taking a portion of it, right? Because there's only a portion of carpet and light fixtures and all that other stuff, right? So you're only taking a portion of your depreciation and then your rest of it. What do you do once you run out of, or once you've kind of like eliminated or eaten up a lot of your depreciation? Where do you go from there?
So there's a couple things. I mean, it all depends on your investment strategy, but a couple things. We have a lot of investors who will invest in a property, maximize the deductions, and then sell it after 3 to 5 years. And they just keep playing that game over and over, whether they do a 1031 exchange, deferred trust. There's a number of tools you can use to get yourself out of those deductions you've created. But that's one thing. The long-term assets, so just to give you an idea, when we segregate a property, on $1 million property, we're identifying about 30% into those shorter asset lives. The other 70% still gets depreciated over the next 39 years. So you're always going to have some write-off. It's just that we're essentially front-loading 30% of that. And obviously there's a number of reasons why you would do that with inflation. I mean, hell, $1 right now is worth more than $1 in an hour from now. So give me my deductions now. You've got a time value of money element. There's a number of reasons why you would want to take those deductions.
Yeah, no, that makes a lot of sense. You mentioned deferred sales trust when you're going to be selling in that 3 to 5 years. What are your thoughts on the deferred sales trust?
I'm not a real expert in those. I'll leave that to you guys. I know you guys do a lot of those within your organization there. We have a ton of clients who utilize them. It's a great tool to find once you've fully depreciated or taken a lot of the depreciation out of an asset. It's a great tool to be able to not have to pay all that recapture tax. Yeah. And so, a number of our investors are looking into those and utilize those. Again, it really depends on your investment strategy and what your long-term goal is on whether or not some of those different strategies, whether it's a 1031 exchange or the deferred trust, makes sense. But we see them being utilized and probably even more utilized now than ever before.
Yeah. Definitely. And I will attribute a lot of that to, Capital Gains Tax Solutions and just the marketing that we're doing out there and the education and the podcasts and all that kind of stuff we're going. One of the things that's super unique about the deferred sales trust that you don't get with the 1031 is that when you do a deferred sales trust, you actually sell the asset, right? And you become a lender. But at that point, right, if you end up finding a new deal, you don't have the time constraints as a 1031. Right. You get more than 45 days to identify. You get more than 180 days to close. You don't have to go back into real estate right away. You could put it in. You could sit on the sidelines. You get liquid. You could wait for the market to go kind of down and find more favorable deals. And then when you find one, right, you can go back into real estate. But what's even more unique is once you go back into real estate, you get a brand new depreciation schedule instead of the one that travels with you with a 1031. So that's a massive advantage. And especially right when you partner it with Eric, right? And you're going to redo your cost seg studies because at that point, right, you have 100% of your depreciation. Whereas before, you might have depreciated, especially if you've, done cost segs in the past and you keep doing them, right? You keep accelerating that depreciation schedule that keeps traveling with you, right? You get to kind of cut that baggage at that point and start fresh. And so it's a phenomenal tool.
No, it is. And you hit it on the head. That's the biggest difference that we see with those investors who use the 1031 exchange versus the deferred trust is that they are stuck with that baggage. You're not getting rid of it. You're just kicking the can down the road. Eventually it's going to come due.
Right.
Unless, like I said, you continue until you die. But, and then the other thing you mentioned, which I just want to touch on again is we have had a lot of clients who anticipate doing a 1031 exchange, the market changes, their finances change, deals fall through all the time, and they end up stuck. And they're like, oh, crap, Eric, what can I do? And oftentimes, if it's not too late, we will refer them out to do a deferred trust, or if they have other assets, we can possibly do cost segregation on some of those other assets just to offset the capital gain. But
yeah,
those are great points.
Yeah, and it's great because that's the other thing too is we can save a failed 1031 exchange.
Right.
So if you don't identify that property within 45 days, it's okay. Like it's not that big of a deal as long as you're in a good 1031 exchange accommodator, right? Some of them are like stingy and they're like, nah, like I'm not gonna let you do that. I'm not gonna work with you. Like I want this 1031, thing. And it's just some of them just it's always better to have the option as opposed to not having the option.
Right.
You want maneuverability because if you back yourself into a corner, you get into that situation where you're a motivated buyer and you have a fat tax that you're going to pay. You make some bad decisions.
I've seen that happen just because their time's running up and they're like, oh, I've got to do something. So even though this isn't the right property or not the right price, they've got to get into it because otherwise they're paying tax on it, or they think they have to pay tax.
Right now, I have 2 commercial buildings that I'm trying to sell, right? And I have a full strategy based upon just 1031 buyers. Like, hey, I know you got like 3 more days before you got to identify.
That's what the price is.
What I got. A building's way overpriced. I know, but you need something, right? No, I'll work with you for sure. But it puts you in a bad spot, and it's you don't want to be there if you don't have to.
Right.
So it's just wise to have those options.
Right.
So, anyways, you guys can learn more about the Deferred Sales Trust by going to capitalgainstaxsolutions.com. We also have a mastermind that we do every Friday at 10 a.m. Pacific, 1 p.m. Eastern time. We had a fantastic guest on today who was talking about crypto and the derivatives markets and how they leverage that to go back into real estate. It's awesome stuff. Super high value content. And we have people like Eric who come on and talk about all their, unique value propositions and how they can save you a bunch of money. And we're all for paying the government their due, right? We just want to pay tips. So,
right. and that's the thing, the tax code, if you have the time to study it, which none of us do because it's thousands of pages, so we usually pay somebody who has studied it.
Right.
But it really, all it is it's designed to incentivize us to do certain things, whether it's invest in real estate or start companies or buy stuff. It's all, the government just uses it to pull these levers on what they want us to do. And so as long as you understand it, it's, the more you understand, the better off you can be.
I think I was talking to one guest. There's like 2 pages in the tax code that's actually like this is you have to pay these taxes, and then the rest is just like how to get out of it.
That's exactly right. That's all it is if you do this, you don't have to pay this tax. If you do this, you get this kind of deduction. If you do this, you get this kind of credit. Yeah. And it's just understanding that, being aware of it, and how to structure yourself so that you can take the most advantage of those. What
is your biggest pushback on the cost seg study?
I got to be honest with you. It's really misinformation and CPAs. Now, I say that lightly. CPAs are a great referral source for us, and we work with CPAs all across the country. But sometimes if the CPA doesn't, and I'll back up here. There's 2 types of CPAs. There's tax preparers and there's tax strategists. Tax preparers, you hand them your papers and they process it and give you a tax return and you pay your bill. Tax strategists take those papers and say, wait, what can we do with these? They actually are way involved way before you get the papers to say, we want to make sure when you get the papers, they say this, this, and this, so that we can take advantage of this, this, and this. And so I think the biggest pushback we get is just from those tax preparers who are just getting paid to process paperwork and get that tax return out. They don't always understand the value. And so they'll sometimes, they don't want to look bad because their client paid a big tax bill last year. And so they'll kind of have different reasons on why they'll push back. And we just get them on the phone and just educate them. We want to be advocates for them and say, hey, your client can save this money, and we'll make it look like it was your idea, and we'll all go away happy. So that's the biggest pushback is just misinformation out there. And CPAs are kind of like general practitioners. They don't know, they don't have the bandwidth to learn everything in the tax code. And so they know a little bit about all the different subjects where we dive deep in cost segregation. So we just want to be their partner and partner with them on that. But that's probably the biggest pushback.
Yeah, absolutely. And just to speak to that, guys, like what that really looks like is that like Eric and their team, they play nice with other professionals, and I think that's a big pushback because we get a lot of pushback with that on the DST too, where it's just like, the tax prefer, or the, estate planner, like they don't know. And they just like, it's a super unique strategy that, we just, that we just happen to be in the right place at the right time with the right people and wise enough to shut up and listen to the super smart guys. Right. Nope. And then we found out and we're like, hey, like, this is brilliant. Like, let's do this. And so, when you tell people, I mean, I even have people that, are $100 million net worth people that have absolutely no idea what I'm talking about. And they're like, this 30-year-old punk over here is trying to tell me what, my professional team doesn't know. And I'm like, okay, that's fair. But like, at the same time, like, I kind of know something that you guys don't know. Otherwise you would have already done it, because I know the advantages, right? And the fact I know your situation, and because of that, and you're not doing it, like, you're either A, misinformed completely, right? Or B, you guys just don't know about it.
And it's 99% of the time it's B. It's not that they've surrounded themselves with a poor team. And that's what I tell CPAs. It's not that you're a bad CPA. It's just you physically don't have the bandwidth to know everything you need to know about deferred trust and know everything you need to know about depreciation and child tax credits and earned business income and all these different things they have to know. And again, that goes back to what I was saying earlier about surrounding yourself and getting the right people. And that's why firms will partner with groups like yours and ours, because they know that they're not, it's the general practitioner versus the heart surgeon. I wouldn't expect to go into my general family doctor and say, hey, perform heart surgery. They don't know it. They know a little bit about it. They probably know that your heart's messed up, but they're not going to cut you open and fix it. They outsource you to an expert who just does that. And you
don't want them to.
No, and I don't want them to. I don't care.
You don't want them to.
No. So let the experts handle it. And that's why it's great to have different niche markets. And like I said, stuff that you guys do, stuff that we do to partner with these CPA firms. It's not that you have a bad CPA because you haven't heard about this stuff. It's just they don't have the bandwidth to be able to be full experts in that area.
Yeah. Yeah, honestly. And to be quite frank and quite honest, right? If your CPA is not willing to kind of sit down and listen for your interest, then you do have a bad CPA. And I highly recommend you upgrading and getting in with the CPA who will swallow the pride, right? And not be so concerned about how bad it makes them look or whatever, right? These are super niche things. How often do people have capital gains events where they're selling, even the ones that are doing it regularly is every 3 to 5 years, right? And maybe they're selling a significant amount of real estate or whatever, and maybe they're a little bit more in the know. But these guys that are selling a business or a highly appreciated stock or, have a fat commercial property they've owned for 20 years, they only heard about a 1031 or, and some of them don't even know about cost seg, right? They just know about straight line depreciation. They don't know. They're just building appreciated like crazy. Right. And so, they don't have those, they're not looking for it. Right? They haven't needed it. It's just not something that they've done. It's not that their CPA is bad or whatever, like you talked about. But if the CPA is not willing to, or anyone in their professional team is not willing to at least, sit down and like have a conversation, then I would recommend, hey, it's time maybe to upgrade. You know, and I don't want to sound harsh or whatever, but I think it's the truth. And those who stop learning, start dying. And you don't want people that are dying on your team.
No, definitely not.
So hopefully that doesn't come off as too harsh and I'll get yelled at for that one. But
no, I thought it was good. You're exactly right.
It's the truth. So, all right. Well, we're definitely, I'm way over. So I got to get out of here and get you out. Eric, where can people connect with you?
Yeah. So you can look me up on LinkedIn. I'm easy to find on LinkedIn, just Eric with a K, ERIK, last name's Oliver. Cost Seg Authority is our website. We've got contact information on there for all of us there. You can also, if you've got a building that you think might be a candidate for cost segregation, we run a free analysis. So give us your information. We'll run some numbers and say, yeah, this is what you're going to save. This is what the cost seg study is going to cost you. And then you and your CPA can decide if it makes sense from there. But yeah, definitely reach out. Use this as a resource, please. If you ever have any cost segregation questions, real estate tax questions, we've got a number of experts here within our firm, CPAs and engineers that can help answer those questions. So please use this as a resource.
Yeah, absolutely. And you guys can connect with us at capitalgainstaxsolutions.com. deferredsales.com. If you're interested at all in learning more about that, or you got a deal that you're looking to liquidate and you're kind of thinking, I don't know if I like where this market's going, and the 1031 doesn't really seem like, it might be the best place. It might be. You never know. That's why we're Capital Gains Tax Solutions, plural, and not just tax solutions. So there's a lot of different things you can do. If you're thinking about it, the best time to get in is early, right? Cost segregation is the same thing, right? The earlier you get in, the better we can plan, the better we can, figure out the best solution for you and your problem to get most tax efficient as possible. So, that's Capital Gains Tax Solutions. Be sure to check out our mastermind. You can find that at the website as well, capitalgainstaxsolutions.com. It's every Friday at 10 a.m., 1 p.m. Eastern. It's awesome. So definitely hop on there. Any final words?
No, that's really it. You've asked some great questions. I appreciate you having me on. Hopefully your audience learned something. Like I said, please use this as a resource. We don't bill by the hour or anything like that. So just want to be a resource for you guys. And thanks again for having me. It's been great.
Yeah. Thanks again for coming on, Eric. Really appreciate it. And thanks again, everyone, for listening to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the Deferred Sales Trust, a 1031 exchange, cost segregation studies, best way to exit tax deferred so you create, preserve, grow your wealth. Be sure to check out Eric's website if you have any questions on cost segregation. That's costsegalauthority.com. Check out capitalgainstaxsolutions.com. Please rate, review, subscribe, post, repost, share, comment, all that good stuff. And guys, we'll see you on the next one. Thanks again. Have a great day. Thanks, Eric.
Yeah, thank you.